China and Saudi Arabia have recently signed a currency swap agreement worth 50 billion yuan, which is about $6.93 billion, to facilitate bilateral trade and investment. This is the latest move by Beijing to promote the international use of its currency and reduce its reliance on the US dollar. A currency swap is an arrangement between two parties to exchange one currency for another at a predetermined rate and date. It aims to reduce exchange rate risks, lower transaction costs, and enhance financial stability. It also aims to boost trade and investment flows between the two countries, as they can settle their transactions in their own currencies without having to convert them into US dollars first. China has been actively pursuing currency swap agreements with its trading partners since 2008, when the global financial crisis exposed the vulnerabilities of the dollar-dominated international monetary system. So far, China has signed currency swap agreements with more than 40 countries and regions, totaling over 3 trillion yuan, which is about $462 billion. The currency swap agreement with Saudi Arabia is significant for several reasons. First, it is the largest currency swap deal that China has signed with a Middle Eastern country, reflecting the growing economic ties between the two sides. China is Saudi Arabia's largest trading partner, and Saudi Arabia is China's largest oil supplier. The currency swap agreement will help facilitate the bilateral trade in oil and other commodities, as well as the cooperation in infrastructure, energy, and finance. Second, it is a strategic move by China to expand the use of its currency in the oil market, which is still dominated by the US dollar. By allowing Saudi Arabia to settle its oil exports to China in yuan, China can reduce its dependence on the dollar and diversify its foreign exchange reserves. It can also increase the demand for yuan-denominated assets, such as bonds and stocks, among oil-producing countries. Third, it is a challenge to the US dollar's hegemony in the global financial system. The US dollar has been the dominant reserve currency and medium of exchange for decades, giving the US enormous economic and political advantages. However, the US dollar's status has been eroded by several factors, such as the rising debt levels, the quantitative easing policies, and the trade wars of the US government. The currency swap agreement between China and Saudi Arabia is a sign that more countries are seeking alternatives to the US dollar, especially amid the rising tensions between Washington and Beijing. The currency swap agreement between China and Saudi Arabia is not likely to have an immediate impact on the global financial markets, as it only accounts for a small fraction of their bilateral trade and investment. However, it is a symbolic step that reflects China's ambition to globalize its currency and challenge the US dollar's dominance. It also shows that Saudi Arabia is willing to diversify its economic relations and hedge against the uncertainties of the US policies. The currency swap agreement may pave the way for more similar deals between China and other oil-producing countries in the future, which could have deep implications for the global monetary system.